Hello, you're watching Proactive. Joining me is Paul McGlone. He's the CEO of Seeing Machines. Paul, thanks for joining us today. Lots of news out recently from the company. So let's start with yesterday's announcement. Seeing Machines has acquired Asaphus Vision. Can you tell us a bit about that, why it's important and what it brings to the company?
Yeah, thanks, Stephen. Really, this acquisition is all about people, machine learning capability, data, and collaboration. And if I take each of those just very quickly, this group is a small but extremely capable group. So we're acquiring some real deep expertise in machine learning and AI, and we're very strongly of the view that this expertise, based on what we've seen in the products that they've developed and the way in which they work and the tools that they work, should help us to significantly reduce both the size of our machine learning models and the computational power that's required to run them on small embedded devices. Now, that's technical, but it's a very, very important part of what we do for our customers. So the machine learning application here is very, very strong, and we see lots of leverage. From a data point of view, of course, this is mission critical to companies like ours, and it's a scarce resource and you can't have enough. So we're acquiring, in this case, a very large amount of data with a quality ground truth in the head and gaze tracking environment that's really important to us, and also for other applications like driver identification and phone use and so on. Now, we have significant data already, and I think all our shareholders know that, but this data set, when combined with ours, significantly enriches both the demographics, the age, the gender, and we think that this combination will produce something very powerful and very unique. It's the thing that enables us to develop features better and faster. So that's really important. Of course, they're based in Berlin. The majority of our business is in Europe. So for the first time, we'll have very experienced people that you can both speak the language and, of course, work during the daytime instead of during the evening. So that'll be really important. And then finally, the collaboration with Valeo is very, very important. They're a very strong customer of ours already, have been for some years, and this really paves the way for a new collaboration.
Paul, can you maybe build on that? How will the Valeo relationship help Seeing Machines?
Well, Valeo are one of these companies that's really a world leader in developing systems, both exterior and interior systems, and all of the technology that enables that software to come to life. So the sensors, the cameras, and they've been extraordinarily successful in developing this area of their business, and they are truly a leader. Now, they were also very successful in collaborating with partners, third parties, and so for us, acquiring the Asaphus business, integrating it fully into Seeing Machines, and then working in a more formal collaboration with Valeo seems to bring all parties a benefit. So they're very experienced, they're very technically sound, highly successful, and working with them more closely is a real advantage to us.
Paul, looking back to last week, you signed an extension of your agreement with Caterpillar. Can you break that down for us?
Yeah. So we've been working with Caterpillar for a very long time, and they're a very important partner of ours. And we tend to, in the past, have had a 5-year rolling contract. And so that contract was up for renewal. So what it did was it really caused both Caterpillar and ourselves to reflect. It was a natural point of reflection, if you will, on where our relationship was going. And we were able to assess what they wanted and what we wanted. The summary is that we were able to develop a path forward, which means that we will be really rethinking the products that we develop for Caterpillar. So we're now on the path of developing new products for them. We have been able to amend the fields of use that were previously exclusive to Caterpillar, and now we will have access to some of those fields of use. For example, construction, on-road construction vehicles, a very, very large segment that we've previously not been able to address. So we'll get access to that. That's additional addressable market. And importantly, as part of that negotiation, we've been able to bring forward the royalties that we would normally have accrued over the new 5-year term into a single one-off upfront payment of $16.5 million US, which is really helpful to us. Provides a benefit to Caterpillar, but it's obviously very, very helpful for us from a cash point of view. Now, as we look at this transaction from an accounting perspective, it's quite complex. And the big question we have to solve with our auditors is, what is the revenue recognition that we're able to apply to last year, FY24, and next year, FY25? And we haven't bottomed that out yet. But we think from a revenue point of view, it should be beneficial to both 24 and FY25. So new relationship, we've got some new things to work on, which will deliver real benefits to us as they come to life. We get the cash up front, and we're locked in again for another 5 years with this great company. So that's the deal.
Paul, in that same announcement, you provided an altered outlook of your full year 24 cash EBITDA result. Can you tell us what that actually means and why this has happened?
Yes. So two key reasons for the adjustment in our EBITDA outlook and for calling it out, and that is margin mix in both our fleet or aftermarket business and our automotive business, and timing. So what do I mean by that? Well, I'll take automotive first. A quarter or so ago, all of our shareholders, in fact, at the end of Q2, all of our shareholders would have seen that we had a drop in royalty volume driven by one particular program. And we've investigated the reason for that drop. It's not systemic. It was just a shuffling of stock versus production. It bounced back a quarter later, but that volume was lost in that quarter. So we've had a slight reduction in royalty volume. The other thing that's occurred is several of the OEMs that we are currently in production with, we tend to offer them two packages of features. One which is, let's say, the high-level feature set, and the other being the more basic level feature set that is designed to meet NCAP requirements. Now, the mix between the two, the relationship between the two has been very constant quarter on quarter until quarter two. And then we saw almost a reversal where several of our OEMs were driving more volume into the NCAP-based lower value features. When you combine that mix effect with the volume that I just described, that has caused an issue for us at the EBITDA line. So that's auto. And in Guardian, our fleet business, we launched our Guardian Gen 3 product at CES. We put the product into early adopting customers. We do what people normally do. We run them in test. We identify issues. A range of technical issues were identified and resolved. Then we had to go through the certification with IATA, and then we go through the certification with each individual company. And the reality is that has taken us longer than we'd expected. So for the full year, we sold a greater proportion of our Generation 2 products than our new Gen 3 products. They have a significantly lower margin, and so that drove a reduction in EBITDA. So margin mix in both fleet and auto, and driven by timing of that new product introduction from fleet. And we expect both of these things to resolve, but we had to call that out. And at the time, we were still unclear about how we were going to recognize the full accounting of Caterpillar. And given the fact that we don't quite yet know what's going to be approved there, we decided to call it out at the same time.
As regulation approaches this month, Paul, do you expect to see a significant increase on quarterly results for automotive? Will it be instant as GSR and Euro NCAP deadlines approach?
Yeah, that's a great question. And look, probably not instant, but we are expecting our royalty growth rates to continue to perform as they have over the course of the last year. We're still expecting 100% year-on-year growth. Now, what's important to understand is we have NCAP and the EU General Safety Regulation. The General Safety Regulation is legislation, so that has to be abided. Stage one from, in fact, this week, is that all new vehicles sold in Europe must have driver drowsiness attention warning systems in place. Now, the issue for us and for everyone in this market is there are a couple of ways to do that. There's a direct method using, say, steering wheel torsion, or an indirect method using a camera. And right now, customers have the choice. But come 2026, that choice is removed because the requirement will be for not just detecting drowsiness, but detecting distraction as well. And for that, you need a camera. So look, there is going to be some volatility, not just for us, but for everybody, in how OEMs decide to meet the requirements. And we're not in control of that. However, there is still a strong movement for an increasing take-up rate. By the time we get to 26, of course, all vehicles will need to be ready with a camera-based system. So we do expect royalties to continue to grow, as we've previously said, and we do expect it to increase, but there may well be volatility along the way as OEMs decide which systems to use.
Given all these factors, Paul, can you confirm that you'll still be meeting revenue and cash expectations for full year 24 and also the full year 25 goal of achieving a cash break-even run rate?
Yeah, that last point is really mission critical to us. So we still believe that we will achieve that in FY25. It could well be a quarter or so later, but very, very much still baked into 25. The royalties are continuing to grow. We are continuing to sell our products. We do continue to enjoy an increase in our recurring revenues. So that from a business perspective, there's a lot of very good measures and programs in place. Some of the volatility that's occurring as these new regulations are introduced, we just have to manage. But we are very focused either by delivering revenue or managing cost for that cash outcome in 25.
Paul, I hope you'll keep us posted on progress on all those fronts. Thank you very much for the update today.
Thank you, Stephen.
That's Paul McGlone. He's the CEO of Seeing Machines.